Okay, so it's not coming in the slide show form at the moment. I think it got stuck up somewhere. So are you able to see the screen? So following are the summarized balance sheet of X Limited and Y Limited. Just to explain, how the non-controlling interest is shown in the consolidated balance sheet and how the number is arrived, how the liability is arrived. So X Limited and Y Limited, they are two companies. Their balance sheet is given. It's a tallied balance sheet with 1,08,000 as assets and 1,08,000 as liabilities. So there is some share capital and reserves, and they are building, equipment, stock, debtors, bank. Is that okay? Fine. Now what happens was, X Limited purchased 60% of ordinary shares of Y Limited for rupees 29,000 by paying by check. Okay. So they acquired 60%. So that means now Y Limited has become the subsidiary of X Limited. Okay. When X Limited will make a balance sheet, it will consolidate all the assets and liabilities of Y Limited in the balance sheet of X Limited in future whenever it does it. Is that okay? Now X owns 60% of 40,000. The share capital of Y Limited was 40,000. If you look at here, what is the share capital? Which was 36 plus 4, including reserves. Okay. So on that day, the total capital including reserves was 40,000. So now they own 60%. Okay. So that means they own the share capital, 24,000 belongs to now X Limited. And how much they have paid? 29. So that means they have paid more. They have acquired worth of 24,000 of shares, but paid 29,000 because they were acquiring 60%. Okay. So they had to pay some premium. Okay, fine. And because this cannot be acquired through stock exchange. So there is a process laid down by SEBI through which you have to acquire. If you are acquiring more than say a certain threshold of 15-20%, then it comes under takeover code, and the company has to give notice to the shareholders and saying that we are going to acquire your shares and we are going to give so and so money. Okay, fine. So they always end up paying some premium. Now, so that means what is the minority interest now? So 40% is the minority interest, 60% is the interest owned by X. So 40% of 40,000 will be 16,000, or we can say non-controlling interest or minority. It's the same thing. Okay. Earlier it used to be called minority interest, but now as per the accounting standard we call it by a name called non-controlling interest. Okay. Now X has paid 29,000 for acquiring 4,000 worth of shares. So they have paid some goodwill, 5,000. Okay, fine. So then if we do the consolidation now, so if you do the consolidation of the company, okay, so we have building 50,000, 10,000. Suppose immediately after this transaction the consolidation was done to find out. So we'll have a goodwill of 5,000 which the company has paid. It will become an asset of X Limited, isn't it? Fine. And if you go to the details, you will find it is there. So 5,000 was the goodwill coming from the extra money which they have paid to acquire shares worth 24,000, and they paid 29,000. Okay. Now coming back to this, so the building will be 50,000, which is the 40 plus 10. So we can see the formulas there. So which is this. Is that okay? Fine. Equipment, similarly we can just add everything. Equipment, just simply sum up everything, assets and liabilities. Okay. Then if you look at the total was 1 lakh here. Okay. Then stock is simply the addition, 15 plus 16. Then debtors, 10 plus 13. Then bank, now bank is 5,000 here, whereas the bank balance is 30,000 and 4,000. Okay, fine. So 34,000 minus 29,000 which X has paid to the shareholders of Y, so the bank balance will come down. So 34, and look at the formula there has been minus 29 on the upper scroll there. If you look at the formula here, it is minus 29,000 which has been shown here. Okay. So then the creditors will be simply the sum, which is the sum of 12 and 3. Okay, fine. And now we come to the equity. The equity will be, now X Limited equity is 1 lakh. So it will be shown as 1 lakh. So nothing of Y will come here, only X 1 lakh will come. Similarly, the reserves of X will come, Y will not come. Okay. And how it will get balanced? Because there will be a non-controlling interest of 16,000 or the minority share which has been coming from here, which is 40% of 40,000. So if we do that, we will find the balance sheet is again matched. 1,24,000 assets, 1,24,000 of liabilities. Is that okay? So to balance it, we have to show non-controlling interest, because all the assets and liabilities have been merged as if X Limited owns everything of Y, but it is not so. So that means there is some liability towards the non-controlling interest which needs to be shown in the balance sheet to match the balance sheet, okay, and show the proper figure. Is it any questions here? Any questions, please? Have you followed? Okay. So let's get back to this thing. Is this clear? Okay. So now we go to the peer and go to Ultratech. So Ultratech P is how much? 53.8. Okay. Now I told you that the P ratio tells you, basically a ratio which is dependent upon numerator side, the market price per share or the market cap, divided by the denominator is either earning per share or the net income after adjusting for the minority interest. Is that okay? Is that clear? Now, if you look at the peer here, now you will find that there are, a median P ratio is how much? 40, 50. So if we just have plain reading, then Ultratech looks to be a costlier compared to the industry. Okay. Grasim is just a number which is appearing, but Grasim we have to exclude because it's not a cement manufacturing company. It is because it owns Ultratech. So we'll exclude from our analysis. Ambuja 32. It is trading cheap compared to the market industry, isn't it? It's cheaper. So normally it would be that if something is cheaper, we should buy it. Something which is costlier, we should not touch it. Okay, fine. So the plain reading tells this. Okay. Then we have Shree Cement, which is 71.04. So it is, trading at a very high PE ratio compared to the industry. Similarly, we have JK Cement. It is also trading at a higher PE ratio. Dalmia Cement, it is also trading at a lower than the market industry. And ACC is trading just at 14. So it's the cheapest out of the lot. Okay. Now, as I told you, normally expensive would mean that it is very expensive and we should not buy it. Or it can also mean that it is expensive because people find that this is a good company, it has a great future in terms of growth, okay, and it is going to grow much faster than the other. So people are buying it and pushing the prices, and the PE ratio normally looks elevated over the time. Okay. So if that's the case, then somewhere you have to stop, because at some point it will become expensive. Even with a higher PE ratio, even with a higher growth prospects, it will not keep growing, and somewhere it will become, overvalued. Fine. So normally when in the market, what happens is when there is a frenzy of buying, people keep buying and push up the price beyond what it should be. Then we say it's overvalued. Okay. Even it deserves a high PE, but it has gone above. So how do we know that? The question mark is, how do we know whether it is rightly priced or underpriced? Okay. So what we do is that we look at another ratio, which is called the PEG ratio. Okay. So if you come to this side, okay, so you will find there is a PEG ratio here. PEG ratio is appearing. So the PEG ratio is something minus here, which is wrong. Okay, this is not wrongly calculated. Maybe there is a mistake here. So what we do is, basically, how do we calculate a PEG ratio is that we take the P ratio and divide by the future growth in earning per share. So it is basically the PEG. It's like this. I'm just writing it here. PEG ratio is the PE ratio itself divided by growth. Okay, growth here is growth in EPS. How the earning per share in the next 3 years are going to grow. If the company is going to grow in future, then the company may look elevated in terms of its valuation. So it depends on the future, not that what has happened. Okay. So we have to get somewhere the number of what is going to be its estimated earning per share, for the next year, 26, 27, 28. Okay. Now, if you go to various sites, you will get this number. I'll just take you to the site where when you fill up the template, you will get all these numbers readily available. Okay. So, now suppose the P ratio is 30, okay, and the growth is say 30%. That means next 3 years on an average the share is going to grow up by 30%. Then we get a PEG ratio of 1. If it is 1, that means share is trading at par with the growth. That should be always the right number. If it is 1, it's fairly valued, but we will never get 1. Okay. Either you may get, you know, 40 divided by 30. So that means it will be 1.33, or you may get 40 divided by 20, you may get 2. Okay. Or you may get, you know, another number called 30 divided by 40, which will be 0.75. So numbers will be like this, either greater than 1, less than 1, or equal to 1. When it is trading at higher than 1, then we say that the company is trading at premium to its growth. Okay, fine. It's trading at a premium to its growth. अगर यहाँ पर देखें हम second में 40 divided by 30, so the P ratio is 40 and the growth is 30, and the P ratio comes to, PEG ratio comes to 1.3. So it's trading at premium to its growth. Okay. Then if it is 40 by 20, it is trading overvalued, 2 times than its growth. Okay, fine. But in the last, it is 30 divided by 40, then we say it is trading at a discount to its growth. Okay, fine. Discount to its growth. So I've just shared some videos. So please read, listen to them. Have you, anybody listened? किसी ने सुना? I just sent a message in the morning. So please go through those videos, okay, later on. आज जरूर सुन लेना उसको. Okay. Now, so there was another ratio which has been now been framed, which is called PEGI. PEGI ratio, okay, which is basically a modification of PEG ratio. PEG ratio, if it is below 1, go and buy. It's, you know, undervalued. 1, it's rightly valued. Over 1, that means it is overvalued. Is that okay? Fine. So it gives you a kind of this thing. But so there is another ratio which has been done, which is basically the P upon growth plus the dividend yield. Plus the dividend yield. Now what happens is the company pay dividend every year. Some of the companies pay, some companies don't pay. Okay. Now the companies which pay, their future growth will get affected because they are paying all the money or some of the part of the profits to the shareholders back. So some retained profits will come down. So that money, more and more dividend means less and less growth in future. No dividend means more growth. I mean, if the company is doing well, sometimes the company doesn't give dividend and the company still doesn't grow, that is an abnormal situation. Okay. But normally, if the company is not paying dividend, so what is doing with the profit? If the company is earning profit, it is deploying back into the business. Okay. So the company will grow. Okay. Now, if the company is paying dividend, so some of the growth will not be captured properly. So whatever dividend you are getting, add the dividend. Okay. So to complete the growth story, to complete the growth in earning per share, which now includes also some dividend which has been gone to the shareholders. So ये तो combined होगी ना growth, पूरी growth होगी company की. Because company is growing, it has already paid a dividend. If it doesn't pay dividend, it will keep growing faster. It will go at 30%. But if it pays dividend, it will go at 20%. So we are adding dividend yield to complete the gap. Is that okay? Fine. Is that clear? Now, in the morning, what I was doing while coming, I just, went to, the AI, ChatGPT, and looked at the PEGI ratio. Okay. So I asked this question, what is the PEGI ratio for all the Nifty companies in India? So it said all the information is not available. Okay. So then, he said he can do it for something. So PEGI ratio is basically PE divided by earnings and dividend yield. Okay. Now, by the way, dividend yield we can always look at for Ultratech here. So what is dividend yield coming? 0.61, okay, which is basically the dividend announced by the company divided by the market price per share. Okay, if you own a share, company has declared 10% dividend, okay, or say 100% dividend on the face value. What is the face value of the share? Here of this thing, face value is just 10 bucks. So even if the company is paying 100%, okay, which is 10, but the 10 will not be the yield, it will be 10 divided by the current price, which is 12,540. Okay, so it has paid you 10 rupees, but your investment now is 12,640 in the share. Okay, so you are getting just 10 rupees. So dividend yield will drop dramatically if the share price keep growing. Okay, fine. On the face value, it is 100%. Dividend yield is not calculated on the basis of how much dividend the company is paying and how much is the face value. We look at the dividend paid divided by the market price per share, so that how much, suppose you buy today 12,000 rupees share, you will get only 10 rupees. So how much return you are getting? 0.61. Is it clear? आपको तो सिर्फ 0.61% मिल रहा है ना. जिस कंपनी बंदे ने 10 रुपये लगाया था उसके लिए तो अच्छा हो सकता है, but if you have to calculate on the market basis, then we have to know that the dividend yield is only 0.61%. Is that clear? Any questions there? Okay. Now coming back to this. So then, it helped me to find out some of the companies, okay. So Reliance, TCS, Infosys, HDFC Bank, ITC and Hindustan Unilever, okay. So it pulled out the numbers, okay. So the P ratio of Reliance is close to about 24.6, okay, fine, and we can go and check in the screener. Then the dividend is 0.4%. Approximately earning growth is about 10% in the next 5 years. That is what he has got from some source, okay, from the screener and some Wall Street number, okay. So he checked that, at what rate the growth will be there for Reliance in next 5 years. So it says 10%, okay. But it is sales growth. Actually, we should look at the earning growth, okay, fine. So AI has not found everything clearly, so it has found the sales growth. So we are saying, okay, sales growth. So the PEGI ratio is how much? 24.6, 10 plus point, so it comes to 2.36, okay. So normally we will take the earning per share growth and not the sales growth. So since, he is not able to generate all the numbers, so he is still trying to give you some answer, okay, fine. Then TCS, it is, trading at 22.6. Now look at Ultratech, it's trading at 44.50, okay, because cement companies are growing much faster. We'll look and see how the earning per share of the cement companies have been projected for the next 5 years. They are around, on an average, around 30%, okay. So cement is expected to grow at 35% in the next 5 years, okay, or next 3 years. So that's why the cement companies are trading at a higher P multiple, okay, compared to, say, Reliance, which is expected to grow at only 10%. So it won't command a very high P ratio, okay, as compared to Ultratech. TCS, it's going to grow at, about 9%. So it's commanding at 22.6. And the PEGI ratio is 1.73 because there is a dividend yield of, say, 4%. Okay. Now we are assuming all the numbers are right. Sometimes you can check also, because some numbers can be wrongly given by the AI also. Fine. So we are not, debating that at the moment, but we are just learning the concept. So Infosys, which is trading at 21.3, and dividend yield is 0.5. Okay. And the growth is approximately 8% on profit. So he has not taken the right number. So it should be profit growth and not the sales growth. So it comes to 2.11. HDFC Bank 0.99. Okay. So you will find that HDFC is only out of all these stocks which is traded below 1. PEG ratio is 1. Okay. Which seems to be quite, valued in terms that you should always buy HDFC. Okay. So it's giving a clear indication that HDFC is the best stock, and we'll talk about that. ITC is 2.4, and Hindustan Unilever, it is has a PEG ratio of 6.4, highly overvalued. It's currently trading at 54.6, but expected to grow at about 6% per annum, and the dividend yield is close to about less than 2%. Okay. So HUL, though it is commanding very high P ratio, it looks to be highly overvalued. Okay, fine, because the growth is also not there. Fine. But now what happens is that, just about another 10 days from now, there will be a lot of reduction under GST rates. all the goods which have been sold by HUL will become cheaper, and this will propel the growth of the HUL also, isn't it? So if you go and see the chart of HUL in the last 3, 4, 5 days, because the market has already discounted that, because on 3rd and 4th the GST council is going to meet, and they are going to announce that next 10 days this new rates will come, all the 12% rates, all the 18% rates will get merged with 12%, and 12% will get merged with 5%, something like that. So it will become very cheaper, and this is to counter the America's 50% tariff basically. Okay, so if we have some ill effect of the 50% tariff, so which will get counterweight because of this GST rationalization. Okay, now let's look at for example, just to go to say HUL and see how the HUL has done. Okay, even the companies like I'll tell you that Maruti, for example, let's say Maruti. Now Maruti has shown a spectacular rise, because all the cars today are charged at 28% GST. It will come down to 18%, except the high-end cars. Okay, so if you look at the chart of Maruti, it has shown last 6 months. See, it has gone up so much after the announcement, after 15th of August, when the Prime Minister announced they are going to make the cars cheaper. He never said cars cheaper, because the car is at 28%, it will come to 12% bracket. Okay. Similarly, if you look at so it was the cars which reacted very, because people buy cars. If they become 28%, it comes to say 12%, 28 to 18%, or maybe some 12% also, some of the small cars. So it will propel the car sales and the profits of Maruti. Okay, and the P ratio will look very high. Look at the the chart of this Maruti, and just see the P ratio now. So let's look at the P ratio. See how the P ratio has climbed. Okay, fine. So this was the P ratio, which was 60, then it came down because there was a growth, kind of a scare. Okay, because the HUL was not growing, it was just supposed to grow at only 1 point. So the overvaluation, weighed very heavily on HUL, because the HUL has been growing at a very fast pace. But lately find that there is a saturation point. We understand why it has happened, why, that's a different story. We have to analyze that. But if you look at, the P ratio has suddenly jumped almost to 31 from a level of say 26. Okay, so the P ratio has gone up in the last few days, because the company is going to do well. Okay, now coming back to HUL. Okay, sorry, Ultratech. So the P ratio, the PEG ratio. Okay, so basically the P ratio by itself is not a very good indicator. We should calculate the PEG ratio or the PEGI ratio. Okay, and how do we calculate the growth? So I'm just sharing you a site here to look at the growth. So go to trading view. So this is a site, okay, which you can open and go to so this is chargeable site, but it gives most of the information free. Okay, go to the markets. Okay, go to markets, go to countries, go to India.